Hi, everyone. This is John Daly. I'm here with my co host Thomas D. House for another episode of the Reagan Caucus podcast. Our guest today is the Chief Operating Officer and a Senior Fellow in Economics at the Fiscal Lab on Capitol Hill. He was previously a research fellow specializing in monetary policy and trade at George Mason University, and you may have seen his writings in some academic journals and maybe even some national publications. I'm talking about Patrick Horan. Patrick, thanks for joining the two of us today on the Reagan Caucus podcast.
Thanks so much for having me.
Absolutely. Well, it's great having you on. Before we get started, can you tell people what the Fiscal Lab on Capitol Hill is?
Sure, be delighted to. The Fiscal Lab on Capitol Hill is a new, independent, nonpartisan research center created to provide Congress with rigorous budget and regulatory analysis aimed at addressing the United States' worsening fiscal outlook.
Excellent, excellent. Well, it's great to have as much help, I think, in Congress with monetary policy as possible. So we invited you on the show, Patrick, before the Federal Reserve cut its key interest rate, and that was just a few days ago. It was the first such rate cut of the year. This was something, as we saw in the news, that President Trump had been asking for some time, not exactly in a polite way. But pressure from the administration doesn't appear to be the reasoning for the cut. It seems directly tied to some weak economic numbers. Can you talk about that a bit, Patrick? What motivated that cut?
Sure, so as listeners probably know, the Federal Reserve has what's called a dual mandate of minimizing unemployment, and that's one mandate, and the other mandate is price stability, so stabilizing the inflation rate. There's actually a third mandate of stabilizing medium to long-term interest rates, but people have trouble understanding what that means. They usually just focus on the first two, unemployment and inflation. And so on the inflation side, inflation is still above where the Fed wants it to be. The Fed's goal is to bring inflation to be at about 2% on an annual basis. It's really more between 2.5 and 3. But on the other side, the employment side, we've had a few weak months. So in the last month we have data for, which would be August, only 22,000 jobs were added on net, and that's the lowest since the end of 2020. And the job numbers for June, 2 months earlier, was revised down into negative territory. In June, jobs shrunk by about 13,000 on net, and so also worse numbers since late 2020. So there's concern that the labor markets are slowing down. Potentially could be heading for a recession. I think that's the big impetus behind the Fed's decision to cut its target interest rate by a quarter of a percentage point.
I saw a number of economists reacting to that rate cut. No one actually said this is stagflation, but they did say this looks like we're headed towards stagflation. Can you describe that what that is for people who may not be familiar with that term? And also, do you think that's where we're headed?
Sure. So stagflation is an informal term. It became popular in the 1970s, and it's combining two terms together. So stagnation and a real economy that is stagnating, low growth, rising unemployment, combine stagnation with inflation, rising price level. Put the two together, you get stagflation. So the 1970s was a period where we saw stagflation. It was very painful. I'm sure everyone who lived through that period remembers how painful it was. So there's concern now that, again, the job market seem to be weakening, but inflation is also higher than where the Fed wants it to be. So there's pain on both sides. That's why there's this concern about stagflation. I would say it's pretty reasonable to be worried about stagflation going into this year. We've had a lot of uncertainty due to tariff policy. We've had GDP numbers that are revised up and down quite a bit. GDP for the second quarter wasn't too bad. If you look at another number, though, called final sales to private domestic purchasers, that's been slowing down for the past couple quarters. That's a number that, if you take the GDP equation, consumption, investment, government, and then exports minus imports, that just takes the consumption side, and then you add in the investment minus what are called inventories, which are part of investment. Why is this relevant right now? Inventories have been going up and down a lot because of the uncertainty in trade policy. So some economists would say, well, let's look at a measure that doesn't include trade and doesn't include inventories. That's this final sales to private domestic purchasers, and doesn't include government either. And that's been weakening. Um, Now, the United States economy has shown itself to be very resilient in response to shocks, so it's not a guarantee that we're going to go into recession. But I think there is much more reason to be worried about recession now than there was, say, 6 months ago.
All right. Well, something to keep an eye on for sure. I want to bring Thomas into the conversation for some questions. Go ahead, Thomas.
Yeah, so you know, the, the part of the purpose of this podcast is educational, and the reason we asked you to come on here is because I have come to trust your your thoughts on monetary policy over the years, following you on online. Can you want to say something a little bit about your own philosophy of monetary economics?
Yeah, so that's kind of a big question. So you kind of think like how I think what monetary theory. You mean like what I think monetary policy should look like ideally?
Maybe, but who are some of your influences?
Yeah, so there's different schools in macroeconomics in particular, and I'm reluctant to kind of subscribe myself to just one school. I think different schools have different points that are interesting for understanding the economy as a whole. I would say though, I think my views come closest to what's called monetarism, which is overlaps with the Chicago school a lot. So Milton Friedman was a big influence on my monetary thinking. Hayek as well to some extent. For more recent economists, I've worked with these people, and I started. In terms of more recent influences, there's a school of thought called market monetarism,
Hmm.
and these are economists who take the monetarist ideas of Milton Friedman, but they also combine them with other ideas, ideas such as the efficient markets hypothesis.
Hmm.
So these economists tend to think money is important, but markets are also very, very efficient, and markets can kind of signal where inflation is going next. So Scott Sumner and David Beckworth would be two big economists in this field. George Selgin is another economist. He doesn't describe himself as a market monetarist, but I think his ideas overlap substantially with them, so he's another influence.
Hmm. And some of those ideas carry into like the policy recommendations that those George Selgin and David Beckworth would support for the Federal Reserve, right?
Yeah, there's a few reasons for this, but in general, these market monetarists who tend to be the kind of prominent free market oriented economists working in the monetary space, they tend to support a proposal for this day and age at least called nominal GDP targeting. I
Hmm.
should say Larry White is another. He's not. I don't know if he calls himself a market monetarist. He's more of an Austrian mix of Austrian and monetarist thinking. He's also a supporter of NGDP targeting, at least for the present day. And what do I mean by that? Assuming you have a fiat currency, and we're not going to a gold standard, we're not going to go to free banking where we just abolish the Fed and banks
Hmm.
can issue their own private money. I mean, there are economists who argue that, and I think there are some examples in history where that worked fairly well. But as
Hmm.
for a practical policy recommendation today for the Fed, nominal GDP targeting has there's a lot of advantages to nominal GDP targeting. So the idea there is that instead of the Fed trying to mostly worry about the inflation rate, that's the growth of
Hmm.
the price level, it tries to stabilize either the growth rate or the total level of nominal GDP. So that's the
Hmm.
total sum of spending in the economy. So if you may remember from macroeconomics class, nominal GDP growth is going to be equal to real GDP growth plus
Hmm.
inflation. So if you target nominal GDP growth or the level of it, you're indirectly stabilizing the other two variables, inflation and real output growth.
Hmm.
So you would let the inflation rate vary in response to shocks. So in fact, one of the big arguments for GDP targeting is that it better handles what are called supply shocks. So
Hmm.
shocks to the real side of the economy. So tariffs would be an example of this. Tariffs are not a monetary phenomenon, but there's some outside shock that could raise prices a bit. It could potentially lead to cause the inflation rate to go up a bit. At least that's what we observe in real time. Under NGDP targeting, the Fed would purposely look through this. It would not be worried, not be concerned with that rising inflation response to tariffs.
Hmm.
So in the short run, inflation would vary, but in the long run, it would still be anchored.
That's right. So according then to this, where this kind of goes against the sort of policy recommendation of the Fed right now, where they're aiming for like 2% inflation,
Mhm.
under NGDP targeting, you would allow for deflation when there's growth, right?
Correct. When there's productivity gains. Yep.
Yeah, that would be very popular with people if their prices went down with time.
I think they would be. Yeah, I agree with that. It depends how you set the NGDP target. Um, because let's say, okay, let's to make it easy, let's assume potential real GDP growth is about 2%. That's what people think the economy can grow at a sustained rate. At a sustained rate. If you do 4% NGDP growth, then you're saying, okay, roughly 2 real GDP growth on average, and then roughly 2% inflation on average. That's what people kind of been accustomed to. So some people say if you're going to do NGDP targeting, that's a good number to pick. Depending on how your trend output growth goes, that might change the medium to long run inflation rate. So if you're targeting 4% NGDP growth, it would take quite a lot of productivity growth to bring you all the way to deflation. That would be negative inflation. You would see definitely disinflation, though. Potentially, you could see deflation, and I agree with you. I think that would be good. There's a lot of economists who think deflation is inherently bad, and I think not so fast.
And why is so this school of thought thinks that there's good deflation and bad deflation, and good deflation happens because productivity makes everything less expensive, but bad deflation is a monetary phenomenon where you're sucking money out of the financial system, so there's less money there's less available money in the financial system, right? And why is
bad deflation?
Why is that bad deflation? What's the history of that?
Yeah, I mean the deflation. So you can think of that as NGDP falls below where you want it to be, falls below that growth rate target or that level target. You can think of that's like total demand in the economy shrinking. And a lot of economics a lot of it's about expectations. It's where are things relative where they're supposed to be. So if you think of, some people say NGDP is basically a proxy for aggregate demand, total demand in the economy. So if demand falls to where it's expected to be, there's less income than is expected to be. And that means, okay, people don't have as much money to pay back the loans that they made, for instance. And so Irving Fisher, who was an economist in the 1920s and 30s, he talked about a debt deflationary spiral where there's deflation and people don't have income to pay back their debts, and then people have to default on those debts, and then there's less demand, and then prices keep falling. That's the bad case of deflation, which is definitely a real phenomenon you want to be worried about. You want to be concerned about.
And that probably happened at the beginning of the Great Depression, right? The sort of
I would say that.
Because I think Milton Friedman said that the bank screwed up by not, or the Fed screwed up by not supplying the financial system with
enough money.
Enough money. Yeah, that's right. So because we're so scared of that, though, we avoid. There's no distinguishing between that kind of deflation and the deflation that just lower prices that comes from productivity.
Exactly.
Was there ever any historical examples of the good deflation happening regularly?
Yeah. So I'm not as well versed in all this, but I do know a little bit about it. So in the late 1800s, there's this period called the Great Deflation from the 1870s to the 1890s. Now, during that period, there were some financial panics and recessions. So I don't want to say the whole period was great, but in general, there's deflation on average of the whole period. That doesn't mean the whole period was bad. You could say there were expansions during that period, and that's like totally fine. There are some economists who have talked about this recently. Brian Cutzinger is a friend of mine. He's written on this in the case of Canada. He's shown that there's there's been historical examples of productivity-driven deflation, and it's benign. It's fine.
So I guess one of the objections I've heard to NGDP targeting, as opposed to this like 2% target that they do today, is that it's hard to do. Is it any harder to do or any more dangerous to try than what they're doing now?
Well, no one's explicitly targeted it yet, so it's hard to know. So that's another discussion. We can talk when we talk about monetary policy. How do you do it? You can talk about goals, and you can talk about how do we get there. So some people say what you just described. Some people might say, well, that's a nice goal, but how would you do it? Because, for instance, GDP data only comes out on a quarterly basis as opposed to inflation, which comes out on a monthly basis. Unemployment comes out on a monthly basis. I think there are good counter arguments there. I think you could simply have statisticians in the government work harder toward a monthly GDP series. There are private monthly estimates of GDP, and it is a bumpy if you look at like a private sector monthly estimate of GDP, it does go up and down quite a lot. So some people say, well, what's the best way to do it? I don't think inherently it's more complicated than inflation targeting, though. Again, with non-GDP targeting, you don't have this knowledge problem trying to distinguish between supply shocks and demand shocks in real time. So that's one big advantage. Yeah, there still would be informational challenges, but I don't think they're inherently worse than what we have under inflation targeting.
So probably if they changed the policy, the whole apparatus would change with it, so that they were, like you say, getting
right.
more.
It would be a new problem, but then we would work toward figuring out the best way to address that problem.
Okay.
Yeah.
So, no, that's very interesting. Okay, so I always wondered that way. It seems like be such a popular thing for there to be lowering prices. Everybody hates increased prices. Because when the thing that increases is our income, we think we did that.
Yep.
But when the thing that increases is the things we're buying at the store, we think the economy did that, and that's somebody's fault
Right.
in Washington, right?
Right.
So all the defenses of inflation not really affecting people don't change the perception, and it is bad. It is bad, but I mean, minimal inflation's minimally bad. But all those arguments don't seem to reach us as citizens, and then it can lead to other political problems when we get upset about it, right?
Yeah, I should say, and in GDP targeting, it will lead to higher inflation in response to these bad negative supply shocks. But the idea here is, well, yes, it's higher, but that's the least bad thing monetary policy could do. It would actually be bad for the Fed to tighten in response to a supply shock, because you're basically saying, here's a negative supply shock like a pandemic or tariffs, and that's hurting the real economy. And then the Fed on top of it says, let's contract policy even more. That would be even worse.
Oh, so you might get some of the equivalent of bad deflation, even though it's masked by the supply shock, right?
Right. And I should say, in defense of the Fed, people at the Fed do talk about the idea of trying to what's called look through a supply shock, and people at the Fed understand, well, there could be some strange supply shocks out there, and we shouldn't try to worry about them. But with GDP targeting, you're by construction not worried about them. You're not going to be worried about the monthly numbers in the inflation series. You're only worried about the GDP series.
Oh, okay.
Yeah.
And then I guess Oh, sorry, go ahead.
I was just going to say, and before I talked about that final sales to private domestic purchasers statistic, which might be better to look at right now, you could theoretically target that over GDP if you preferred, but it's still a metric of nominal income. So kind of in GDP targeting, that's like a specific target. The broader category would be nominal income.
Okay. So then another thing I was wondering is, like, going back, we talked about how that they're cutting the rates now because of the employment numbers. How do you feel about that? Should they be cutting the rates because of the employment numbers? Is that the right thing to do?
I think there is an argument to be had there, but it's a tricky argument, or it's a tricky issue, and I could see arguments both for and against, because the Fed does have this one mandate to produce maximum employment. The flip side of that is minimize unemployment. And if it's worried about labor market weakening, then that's an argument. Well, we have this mandate to try to mitigate that, and if we think it's kind of worse, we should take steps to we should adjust monetary policy accordingly. Thing I haven't talked about yet, most economists would say that monetary policy can affect what's called real variables in the short run. So real means not denominated in dollars, not inflation, like real GDP. That's output once you adjust for inflation. Unemployment, that's a real variable. A lot of economists say, okay, monetary policy can temporarily affect that because it can change how much liquidity there is in the economy, so it has a real effect in the short run. In the medium to long run, it only has an effect on a nominal variable, like inflation. That's why there's also economists say, like, you should put more weight on inflation than unemployment, because inflation is what you really stabilize. Where unemployment goes in the medium to long run, that's based on education and training, other variables beyond monetary policy. And again, another argument for NGDP is NGDP doesn't help you target unemployment, but it can do the next best thing, which is stabilize a variable that includes real output growth, and real output does track employment quite closely.
Okay.
So where does that leave us with the decision this past week? I could see it either way. I mean, I think NGDP numbers were pretty high in Q2, so maybe there wasn't a good reason for cutting the rate. But on the other hand, if you think NGDP is going to fall a lot, then that would be a good reason for cutting. I think these conversations would be these discussions about changing the federal funds rate, the Fed's interest rate target. I think it'd be more fruitful if people had a clearer argument for why they think variables are going to go in the way they want them to go. Where I think conversations would be clearer if Fed policymakers could be clear about where they specifically think inflation and unemployment are going to be a year from now, and how much weight they're putting on each variable. Because if you clearly say, well, inflation is higher than target, yes, unemployment it's looking like it's getting worse, but not quite there yet. If you specifically say, in my model where I see how employment's going to look a year from now, I see how bad it's going to get a year from now, I value unemployment, I value it at this parameter, let's say, therefore I justify a cut. Or say I spell out a rule, for instance. Listeners may be familiar with what's called a Taylor rule. A Taylor rule is basically a formula for how you set your federal funds rate. So there's different ways to do this. You could set the interest rate in response to the current level of inflation, the current level of unemployment, or it could be a forecast of it. And people can have honest disagreements about where the forecast of these variables is going to go. But unless they're really clear about it, it's kind of not very fruitful, because you could always kind of pick and choose. Like, well, this data says you shouldn't cut, this data says you should. And that's what happens when you have a discretionary approach, which the Fed likes. It gives them more flexibility, but I think it creates more confusion.
Oh, okay, so you would support a more like just a clear rule that they go by and then go with it.
Yeah, I think that like a rule, like a Taylor rule, but you respond to NGDP changes. That would be my preference. People will respond to that, but then there's not much flexibility. There's not much wiggle room. Or what if a rule is wrong? Well, a compromise could be, well, you follow your rule and you follow the rule set, but maybe you could be a quarter of a percentage point either higher or lower than what the actual rule points at if you want a little more flexibility, for instance.
Oh, okay. So one thing that I think that the audience will probably be interested in hearing your opinion on is, what the heck happened with the inflation over the last few years? What caused that? What do you know? Do you know now? Is there some sort of consensus, or is there a very, well, maybe not a consensus, but a very strong argument to be made for one interpretation? What are your thoughts on that?
People still disagree. I would say the mainstream view on inflation, this is the view, for instance, articulated by people like Ben Bernanke and Olivier Blanchard, would be that there's three big factors, and the first factor would be disruptions to supply chains during 2021. We're still in the pandemic. Number two, Russia-Ukraine war causing energy prices to rise a lot. And then number three would be excess demand, and that would be loose monetary policy, keeping interest rates too low for too long, letting the money supply grow more than normal, more than should have, plus expansionary fiscal policy, running big fiscal deficits. I think a lot of economists think it's like a combination of the three. Now, when I look at inflation, I think of inflation, it's ultimately a monetary factor with a caveat, and that monetary factor is that what I mean by that, it's really how much demand there is in the economy, how much money there is relative to goods. That is something monetary policy controls. So supply shocks really shouldn't affect inflation unless the central bank is letting it affect inflation. And maybe they should, because I just talked about the NGDP rule and why I think that's good. So I don't think you can really fully separate them. Now, there are other ways to kind of decompose supply from demand. My former colleague, David Beckworth, has he and I have a paper where we talk about this, and we say, yes, there was some supply shocks, mostly demand, though. So mostly keeping interest rates too low for too long. Eventually raising rates, but again, falling behind the curve by about a year in 2021 to 2022. Fiscal policy running big deficits.
Okay. So, I think that seems to be what the common sense was, but that ends up being there. So
yeah, I think some people wanted to blame it mostly on, it's all Russia-Ukraine, so you shouldn't raise rates at all. There were some, I don't think there were, probably not most people, but some people were arguing that. I think that view is, most people would not agree that view is correct.
Okay. So now I guess the other thing is, so obviously people hated the inflation and it has had a big impact on politics because of it. We've always found out that people will sign off on just about anything if you can do something about inflation, because inflation's so bad. In recent months, though, the president has we try to stay out of too much partisan politics here, but the president has been pressuring the Federal Reserve to lower the interest rates. and I don't think the president's an expert on monetary policy, but he liked it because when he was a real estate guy, or he still is a real estate guy, he liked what it did with the real estate market when they would cut the rates. What do you think about this pressure of the executive branch on the Fed's independence? And what do you think about what do you think about that? Is that good for monetary policy, or are you concerned at all about the possibility of somebody who's a loyalist being named Fed chairman? What are your thoughts on this?
Yeah, so I think central bank independence isn't like a strict binary. It's not you have independence or you don't at all. It's actually kind of like a gradient because on some level there's going to be some government entity that oversees the Fed, and you want that to some extent, right? You want accountability. So 100% central bank independence, the central bank can just do whatever it wants, does not accountability. That actually is good. I would still say in general, central bank independence is a good thing, though. You don't want the central bank just say doing what the president or the Congress wants it to do. We kind of treat monetary policy separately because there's a lot of people in government, the president, the Congress, whoever's in charge, they have a strong, if they could control monetary policy in the way they want, there's a strong temptation to loosen policy to boost their odds of being reelected. Another argument right now about why are people in the government, particularly in the executive branch, why are they more interested in telling the Fed what to do? There's this argument Congress is running such giant deficits, lowering interest rates would help make it easier to pay for those deficits. But that's not what the Fed's mandate is. It's not to keep the government's operating costs lower.
And that would be a hidden tax on people, right? To do it that way.
I think the tax would come in the form of higher inflation.
Higher inflation, yeah.
There is, yeah. Where was I going with that? Yeah. So central bank, am I worried about it? Yeah. I mean, so the Senate confirmed Stephen Moran, who is on the Council of Economic Advisors. They confirmed him to be a member of the Board of Governors because there's an open slot. And he has said that he's taking leave of absence from the CEA, the Council of Economic Advisors, but he's not fully gone, though. And that's, to my knowledge, no one has done that before. And that does create at least the appearance of a conflict of interest, kind of being both at the Fed, which is supposed to be at least relatively independent of the rest of the government, while also being at the White House.
Mm-hmm. Yeah. Do you know anything about his bona fides as an economist? Or?
He went, I believe he got his doctorate at Harvard, and he was on Wall Street for a while. He has some idiosyncratic views about monetary policy. He believes that the U.S. dollar is excessively strong and that hurts manufacturing. So he's talked about how that can be a negative, and some people wonder, well, do you want to bring that view to the Fed? Because the Fed doesn't really do exchange rate targeting; it does inflation targeting. I would say he's definitely he's a qualified economist. Yeah, I'll stop that. Sorry to take a pause. Yeah, I'd say he's definitely a qualified economist, but it's unclear to me what his goals would be to be on the board, what he thinks the optimal monetary policy should be.
John, do you have any questions?
I did. This is sort of unrelated, though. You talked about the deficit, the huge deficits, which we're dealing with right now. There's a new column. So the Fiscal Lab we talked about at the beginning has a Substack. I noticed there was a new column out there by Parker Shepard and William Beach. And they look at, in this piece, our federal deficit and what economic growth rates would need to look like in order to eliminate the deficit. I sort of laughed at the headline because in my head I'm like, I don't think there probably isn't a way, but I want to ask you, for those who haven't read it, is it possible to grow ourselves out of this deficit?
It would be very, very unlikely. And and thank you for bringing up the Substack, the Fiscal Lab Substack. So if listeners are interested, you can find our Substack. It's called Fiscal Lab Notes, and you can find it at notes.fiscallab.org, and please subscribe. So as you mentioned, Bill and Parker have this Substack post on this topic, economic growth rates to eliminate the federal deficit. So they run some numbers to figure out, okay, what would that be? So the idea here is okay, maybe you don't need to cut spending, maybe you don't need to raise taxes, maybe you can grow the economy through some combination of policy changes, and then with a bigger economy, you get more tax revenue, and you get rid of the deficit that way. So my colleagues point to the Congressional Budget Office, which says that it thinks that real GDP growth over the course of the next 10 years is going to be about 1.8% on average. Not every single year, but that's what it's going to be around on average. Now, to get to this goal where you eliminate the deficit without having to make any changes to spending or revenue, GDP would need to grow 2.51 percentage points per year faster than the baseline of that.
Okay.
So it's not 2.51, it would be 4.31, or it is 1.8 plus 2.5.
So we need to build armies of AI robots really quick, right? Is that what...
Yeah, I mean, and that kind of growth you've only seen in about 30% of quarters in history from like 1947. It's just unrealistic to think that's a possibility. That's just like a very, very pie in the sky dream. So the short answer is no, unless there's a miracle, and then you shouldn't count a miracle. No, the answer is you can't just grow yourself out of the deficit.
And of course, the tariff policy is working against this as well, because of...
Yeah, I mean, it's interesting because on one hand, tariffs do raise revenue. On the other hand, they do reduce output growth, all else equal. So which one is dominant of the other? I'm not a fan of the tariff policy, and I think it's mostly counterproductive. I suppose I could be wrong about that. We'll see what real GDP growth looks like over the course of the next couple quarters. There's a lot of uncertainty over the tariffs, what's actually going to happen with the tariffs. It may not just be the tariffs, it might be the uncertainty over the tariffs. The Supreme Court might rule that many of them are unconstitutional. Yeah, I would say that the Trump administration likes to argue, well, we're bringing lots of revenue that way. I think it's a more counterproductive. I think it's a counterproductive tax. I think it's not a very efficient tax. Yeah. So yeah, I think tariffs do more harm than good. I could be wrong about that though.
Well, it's my understanding that most economists think of tariffs as one of the worst types of taxes when it comes to economic growth. That things like, even as much as a lot of people hate property taxes, they're less distortionary than like tariffs.
Correct. Right? Correct. Yeah. Tariffs were a popular tool historically. They're easy to administer tariffs because historically at the port you would just collect the tariff because you see the ships coming in, and you could be a smuggler, but that would have been illegal and that would be hard to do. So historically, tariffs were easier to administer relative to sales taxes or income taxes. We didn't really start to do income taxes until the 1900s because it was hard to do. That's why tariffs have historically been popular. They are popular among developing economies that don't have great state capacity to administer more complex taxes. And I should say I'm not a huge fan of income taxes either.
Yeah.
I would say they are. I think most economists would say they're still preferable to tariffs, though.
Yeah, that's right. Well, they say that. So generally, if you have to bring in government revenue, it's best to do it in a way that doesn't discourage investment and growth and all of these things. Right?
Yeah, I would say many economists favor what's called a consumption tax, and there are proposals to make consumption taxes progressive. The idea there is when you're taxing consumption, you're not penalizing savings. And some people say, you're not real well, it's kind of hard to do that. And it might be harder to make it progressive, but I think that's like kind of the ideal. Like, how can you tax consumption over income and savings, and how can you make it progressive?
I sort of cracked up earlier, Thomas, when you said, most economists oppose these tariffs, and I think, as far as I've been able to tell, that they all do, except for the economists in the
work for the White House.
The vast majority of economists do not favor. The vast majority of economists do not favor tariffs. I mean, sometimes you'll hear this argument. Well, it's not really about the tariff. It's a means of getting a better trade agreement. I haven't really seen that really play out very much, because then the goal would be, well, then ideally the tariff should be close to zero. Then that should be the end goal, and it's not clear to me that that's really the end goal here.
It feels like there's been so many rationalizations for it. We see about the trade deficits. And then trade deficit gets worse. We've seen about, U.S. manufacturing. We got to bring that up. It's gotten worse as a result. So
I think that's a good
run out of.
That's a good example how manufacturing has actually lost a lot of jobs relative to other sectors over the past several months. So, because bear in mind, a lot of people say, well, let's do tariffs to produce more stuff domestically, but there are a lot of inputs or intermediate goods that manufacturers need from overseas. So, for instance, like aluminum from Canada, so you put high taxes on that. The people who are building things that require aluminum, that becomes more expensive. That becomes harder to make in America.
Mm-hmm. I mean, that happened 20 years ago with the steel tariffs with President Bush. He didn't like, he was more of a free trader philosophically, but he gave into the political temptation to impose steel tariffs because he wanted to win Ohio. So
yeah, that's true.
And then there ended up killing more jobs than it created. So for that reason.
Yeah. Well, we are a little bit on a bit of a time crunch there, Patrick, but we really appreciate you coming on the Reagan Caucus podcast. It was great talking to you. This was very insightful. We appreciate it, and we'd love to have you back on sometime if you're willing.
Sure, that'd be great. Thanks so much for having me.
Yeah, thank you so much, Patrick.
Yes, absolutely. And thanks for tuning in, everybody else. If you watched today's episode on YouTube, as always, we ask that you like the video and subscribe to our YouTube channel. And if you're listening to us on Spotify or Apple Podcasts or some other audio platform, please make sure you like and subscribe as well. And we will see you next time on the Reagan Caucus podcast.